Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul asks Aaron how many people actually beat the market. By focusing on the process and methodology of how they would even try to answer this question, they go through a variety of hypotheticals. Investment horizon matters. There are also investment risks, personal risks, and career risks to consider. They compare active managers to professional gamblers to examine how what may have worked in the past for an individual may not work in the future at scale. Listen to the end to see why there is probably less than a 1% chance of consistently outperforming a benchmark over long periods. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks, everybody, for listening.
Great to be here as well. Not that long ago, in kind of one of our casual conversations, Trishul asked me the question, how many people actually beat the market? And I first took this as like almost like a riddle. It was like he was asking me as like a trick question just to have fun with it. And so like I didn't answer immediately. I want to kind of give my thought process that, well, it's probably something like half beat the market, half don't. But let's account for like fees and what kind of trying to figure out what he meant by the question. So I guessed, I don't know, 45% will beat the market in a given year. And then it's like, well, but I guess maybe, but I know that there's good data that actively managed mutual funds, it's something like 80+% can't beat the market after accounting for their fees. But it's also like that's like it's like a year by year data, and that 80% changes. Also, that's looking at like U.S. large cap space. So does he mean how many active managers in the U.S. large cap space are outperforming a U.S. large cap index, like a S&P 500 or Russell 1000? Or is he asking like all investors, any kind of active strategy beating any market or any index? And then it's like, well, okay, if we're including people who just buy ETFs, almost by definition, they have to trail the market just by the ETF expense ratio. They might only trail the market by 1 to 5 basis points, but they still have to kind of trail the market. Okay, so maybe there's more people. And then if it's looking at kind of professional investors versus retail investors, and kind of try and include that, we might have good data set from custodians, but then my next question is like, well, where's the data set coming from? What's the kind of methodology? Because if there's someone who has picked a few stocks, they're just kind of doing it for fun or doing it by themselves, the concentration, just that not having a widely diversified portfolio, like that concentration would imply that there's a greater variance in those returns. And so we probably have a higher percentage of people that will have just a few stocks that could outperform the market. They just happen to buy just the FANG stocks: Facebook, Apple, Netflix, Google, and Amazon. And those over the last 5 to 10 years might have outperformed the S&P 500. But two things, my next kind of thought process. Well, one, if we're looking at retail investors, most people will hold some cash in their account. Either just they're using it for the reserve perspective, and that's money they need. They just happen to keep it in the same account. Or this is money that they've been depositing or selling. It's like, how do we account for cash in the account? Because if we're counting the cash, then that's definitely going to be a drag to all of those investors, where it's going to be even harder to beat the market, or whatever the kind of that definition is. And that, again, kind of, is it appropriate to include the cash in that question? Or is it not fair because that's not because just like life in general has requirements and people need to have that cash money. So like, is it not fair to include the cash, but also is it not fair to exclude the cash? And then also I think like, yeah, over the last 5 to 10 years, it's probably been really, really hard to beat the S&P 500. It's done amazingly well. What if we look at a longer time frame? Well, if we go back 15 or 20 years, and then it's also, well, it was hard. One, you couldn't get ETFs as cheap as you can now, going back 15, 20 years ago. Two, they weren't quite as popular, but we'll give that. But then, like, even if you were trying to buy those few stocks, you started to have commissions involved in that. And so was the inability to buy a stock commission free being compared to just an index, is that a fair comparison? And all of these things were going through my head in the like 5 minutes that Trishul was waiting for his answer. And it led us down this path of, one, I'm kind of asking what he meant by the question, but two, like, just how do you even start to think about how to answer the question? So Trishul, first, what did you mean by the question? And like, were you trying to trick me, or were you curious if I could make this guess? And then two, I'd like to kind of try to explore how you and I might answer this question differently. So how many people actually beat the market? What did you mean by that question?
Yeah, Aaron, it's a very big question, and there's a lot of nuances to think about. But I think it's probably the most important question somebody should think about if they ever plan on investing. And I'll get to why I feel that way towards the end of this conversation. But in terms of the actual question itself, how many people actually beat the market? Well, yeah, we have to put some goalposts around this because it's so open-ended that it's hard to draw any meaningful conclusions without, probably outlining a few things that are sensible. But at the highest level, I want to say probably there is no answer, even if we try to perfectly outline what we're looking for, because it's just such a big problem or a big question. But however, what we can do is, if we try to, again, put some parameters around what we're trying to get at, we can then hopefully use the data that's actually available to draw some meaningful conclusions. And I think that might be insightful because at the end of the day, even though a question doesn't have a definitive answer, there can be insights that can be drawn from information that's available. If we had all readily available knowledge, the question, I would put it like this. Let's say you have 100 people and you're able to do this crazy randomized trial where you put 50 in one group and 50 in another group. And in the first group, you say, whatever money you earn, the moment you say you're ready to put that money to work for your long-term investment goals, you go ahead and put it to work using an actively managed strategy. And what that means is you just kind of do whatever you want. But what you have to do beforehand is outline a target benchmark, outline a realistic goalpost that you're trying to beat or match or even do better than. And what that means is you might say, okay, my benchmark is I want to earn 5% a year adjusted for inflation on a go-forward basis. Or I want to beat the S&P, or I want to be a 60-40 bond portfolio. Whatever that is, you define it beforehand, right? Not after the fact, but beforehand for all these 50 people. And then you go out for the rest of your life for the next 70, 80 years, and you try to beat that benchmark. And then you come back and we say, okay, how'd you do? And then for the other 50 people, you say, okay, you have to define your benchmark, whatever it happens to be. And then we'll have a passive portfolio designed to match that benchmark, come as close as possible. And these days you can kind of do that for with almost 1 or 2 basis points, depending on what your benchmark is, maybe a couple handful of basis points. But the notion is after, this 70, 80-year time frame, assume these individuals are in their 20s. Well, we want to say, what percent of those 50 people that were actively managing their money ended up actually beating their benchmarks by a significant amount, enough to cover the taxes they may have to pay, because you want to beat it on an after-tax basis. You want to beat it after all the fees that are involved. And of course, if you're devoting your entire life to this, you probably want to be compensated for the amount of time and effort you're putting into this. Meaning, if you spent the next 80 years working 8 hours a day trying to do this, and you only end up ahead by $10 or $12, well, that might not be the best value for the amount of time you put into this effort. So this is my imaginary scenario that obviously we don't have the data for it. We probably never will. But if we did, it'd be nice to know, how did these 50 people do versus the 50 people who were in the passive portfolio? What percent of the people in the the actively managed portfolio actually beat their benchmarks? And also, what percent of the people on the active side beat the passive side?
Okay, so it sounds like you are trying to kind of define a little bit like that the active managed mutual fund or any kind of just active managed portfolio, kind of like, is it worth the time of the manager kind of question. Which is, I guess, that's the best way that I can think of to quantify the cost of the time, I guess I'd say. That because I don't want to go into like how much different people make at different jobs, and like, can they outpace that other career earnings kind of thing. But this idea, like, okay, if the cost of your time is that mutual fund expense ratio, can we outperform that? It sounds like that's what you're trying to do.
Yeah, I guess what I'm trying to say is you should probably outperform by, I don't know, maybe a 0.10% a year, just something
Okay.
meaningful, more than $1.
Okay. The next, so, and I guess I like that idea of like you get to design your own benchmark. You beat whatever benchmark you pick.
Right.
One thing I'm curious, like that earn 5% per year number. If I'm thinking like long-term average, I feel like that'd be pretty easy. But if it's earning 5% every single year, that becomes very, very difficult.
Well, yeah, I'm happy to say that, yeah, this is your average return. And over this long period, there will be dips and whatnot. But also, these have to be realistic, meaning there has to be an index option that can do this very cheaply. So I don't even know if that exists at this point. A 5% index fund.
Okay, that's good. Okay, so I get, but I like the idea if someone's benchmark is earning 5% per year, because that actually sounds like what different institutions and pensions and other kind of large funds for insurance companies or other retirement obligations, that 5% fee sounds like an appropriate benchmark, because that if they can get that consistent 5% return along with some actuarial math, they can meet their obligations pretty consistently.
Right.
But in practice, I'm trying to think of, okay, that actually might be closer to that 5% per year, which might be a good challenge. Not a 5% average, because I would just do an all equity portfolio over any long time frame, and I'm going to guess something like 90+% of equity portfolios outperform 5% per year over your 70, 80 years. I feel like that's almost too easy.
Well, so you found a few gotchas. For example, I can say I'm going to be bonds, but then I'm going to invest in equities. So
yeah, exactly. It's like, that's kind of so. I guess that's why we have to do it kind of on a risk adjusted basis. Um, but yeah, it's uh, so you're right. That's exactly the question. It's like if you get to choose your benchmark, we're trying to make it appropriate to what you're actually trying to accomplish. But it's like it's almost like you get to choose your benchmark within reason. Because we're trying to distinguish if you're doing a 60-40 portfolio because you need that money to live off of, and so you need to have bonds, then it's also not fair to compare to an all equity benchmark. There's no way you're gonna catch up. But on the flip side, if you're going to be all equity, don't choose the 60-40 benchmark. Don't choose the bond benchmark. So it's like choosing a benchmark within reason kind of thing.
Yeah, like in the professional manager space, you have to state your benchmark and you have to also make investments that align with that according to your investment philosophy.
Yeah.
So there are rules you have to follow there. So in this hypothetical example, let's say you must stick with a style that aligns with your benchmark. Otherwise, the magic benchmark fairy will eat you.
Like all I have to do is outpace inflation.
Right.
Okay. So kind of get to pick your benchmark. The 70 to 80 years, it's also one of those things of, okay, that makes sense if we're trying to make plans moving forward, but I'm not sure looking back if we have good data on that time, both in terms of kind of benchmarks, active managers. I guess I don't even know I don't know how popular mutual funds would have been in the 50s. They really didn't come into play until 80s and 90s. I know they existed going back to the 1930s. By the two acts in 1933 and 1934. So one, like we have data going back farther than that in terms of equity index and probably like a treasury index. But mutual funds as they existed, it weren't even like legally structured until the 1930s. So, but then like there's the popularity aspect. Like, I don't know how I don't know how the methodology would work like that. If we're like, okay, we're trying to give a 7-year time frame, which makes sense for someone in their 20s, but then we'll have to kind of like beware of like what data do we actually have and what can we depend on. But I think that's why a lot of academic research they acknowledge these difficulties of, okay, we have good data for 20 or 30 years. We have okay data on the scale of 30 to 50 years. And then we have some data going back farther, but it's really just like again, US large cap and a 40% bond portfolio, like a US Treasury portfolio. And so it's like if you extend your time frame too much, you almost only can compare to US large cap and US Treasury. So you make a 60-40 portfolio, and that's what you're comparing now. And so that gives us the bigger sample size because it removes some of the like volatility constraints of just different economic cycles. Where if you pick 10 years from like 1998 or 1999 to 2009, and all you see is this flat S&P 500, is like yes, that's true of that 10-year period, but it's not representative of the longer history that we can be more confident on. So I don't have an answer to a question. I don't even know if I'm asking a question, but it's just like I think about that when you say 70, 80 years, it's like, yes, we want to try and improve our sample size as much as possible, but there are real world constraints to how we can do that when we look at methodologies.
Yeah, you're absolutely right. And here's where we have to use heuristics and we have to use kind of rules of thumb and a little bit of intuition along the way to make some reasonable assumptions on how we might possibly get to some sort of answer to our big overarching question. And you're right, a big constraint is the data. It's one of the things where if you're in the financial space in particular and you're trying to do scientific research, it's always down to a constraint of having a limited supply of data. This isn't, a situation where like, if you're doing a physics experiment and you're rolling a ball down the hill, you can kind of replicate that, 2000 times and get an average. You kind of have only, for example, one time period to work at with. And sometimes the data is kind of incomplete for that entire time period. So there's certainly rules of thumb that we can pull into to play. One of the rules of thumb I used to use when doing research at the hedge fund was this notion of commonality. And the idea there is if you have a rational idea that makes sense under one specific situation, in theory, if that rational basis is strong, it should make sense under another similar, although not exact situation. So, for example, if we say that humans behave irrationally under these conditions, and we've observed this irrationality in the US market with the S&P going back 50 years, well, in theory, if humans are investing in the European market and they exhibit irrationality according to that similar thesis, well, then that particular signal or that particular set of outcomes should be visible in the European data. And using this type of analysis, we can, with imperfect data, try to draw meaningful conclusions that can hopefully fill in some of these blanks.
Yeah, I will get the phrase right. I think that's out of sample testing. Does that sound right? Where it's a statistic things where you have this data set and you've made this observation and you try to apply the same observation to another data set out of your sample that's still taken from the overall population and see if the same kind of rule applies. And that's what I wanted to kind of double check or fight against data mining, where it just happened to be the case that it showed up in that particular sample, not that there's any strong causality or inference or correlation from that particular sample.
Yeah, that's exactly right. So in the financial markets, two good ways of doing this is you try to find a neighboring or a different market that's similar, like we said, in another country. The other way is you look at a different time period. For example, if you just look at, the US and Europe over the same time period, it may not be truly out of sample because, for example, there could be an event that ties both markets together that influences both markets that's unrelated to the thing that you're testing.
Yeah.
And then at the same time, you could look across time, in the US market, but compare two different periods. But then again, there could be other events that were common in the first period that, for example, just were not an issue in the second period. And that's why a lot of this analysis gets very tricky. But again, hopefully we can still try to draw meaningful conclusions by just looking at these various subpopulations and understanding, kind of what the drawbacks are. And from that standpoint, maybe there is some insight that can be drawn. Like for example, I realize that we probably will definitely not meet the randomized trial where we put these 100 people in a box for their entire lives and monitor them. We don't have the resources for this particular podcast to put that to work. But what we might do is understand that some sort of representation on or correlation that happens. For example, if we understand that, maybe we said, let's say half the people beat the market every year. Well, then we look, what happens after 10 years if that number is much, much smaller. And then after 20 years, if that percentage of the population is smaller still, well, we're finding that there's a relationship that the longer the time horizon, the less likely it is to have individuals that beat the market. And if we understand that we have strong data in the 10-year time frame, we can perhaps extrapolate. We can use that data to move beyond that time horizon to infer what might happen in 20 years or 30 years.
I think that was another way I kind of interpreted your question. One of my thoughts was, okay, because I could think of, again, that a little bit of wider effect, a little bit like there's a 50-50 chance, maybe a little less due to fees, but that's in any given year. So if half the people, let's say 49% people could beat the market in any given year, kind of after accounting for fees a little bit, then the odds that those people repeat again the next year get cut in half again, and the odds they repeat again the next year cut in half. And I could conceptualize just how taking that exponent of anything less than 1 goes to 0 really fast. So I kind of, if you had a 45% chance of beating the market, to do that 6 years in a row is less than 1% chance. Okay, what if it's a 49% chance of beating the market? Do it 7 years in a row, you're less than 1% chance. Okay, well, actually, if you stack it in your favor, if there's a 55% chance that you're capable of beating the market, what are the odds you can do it 6 years in a row? Well, now we're at a 2.7% chance. What are the odds you can do it 8 years in a row? Now, again, we're less than 1%. Okay, let's stack it even further. There's a 60% chance that you can beat the market in any given year, which I don't think is plausible. But let's give it that. Trying to do that 10 years in a row, again, you get below that 1%. Just doing the math of if there's a 60% chance of doing it in any given year, the odds of it happening over any long stretch are almost close to 0. And so I think when I started thinking about that, I almost wondered if that was your intent with the question to get me thinking about it, where even if they could do it in any given year, can they repeat that over any lengthy time frame? Because I think when we talk about equities, I talk about clients, we're only investing in equities if it's a 10 plus year time frame. So I think that's kind of my personal, I always like I want to say benchmark, but that's like, I don't want to get confused here. That's my personal time frame measurement of equities for 10 plus years. Anything shorter than that, we need to start introducing bonds because of volatility. There's different economic cycles and market cycles, and the odds of anyone beating the market 10 years in a row are definitely less than 1% and probably pretty close to 0.
Yeah, and it's interesting that we can draw even meaningful insights without even running a study. And I think you made a pretty good insight. So one thing that's very important to realize is that average market return, the average return of the market, which is basically, like if your benchmark is the S&P, it's the S&P return. It's the average return of the stocks of the 500 largest stocks in the US. Well, in that case, what that average return implies is that half of the dollars invested in the market will do better and half will do worse. And you take the average of every dollar invested and you get the market return. So that just mathematically that's the case. And yeah, you're right. You can kind of just use simple math to come to a pretty quick understanding that the chances of beating the market every year in 10 years is very small. And then you take that 10 and move it to 20, 30, 40, 50, 60, 70, 80 years, you get an almost impossibly small number.
Now, so part of the caveat to that is that's a binary construct. Either yes, you beat it, or no, you didn't. Where in reality, if you outperform the market by enough in any given year, then or whatever your personal benchmark is, if you outperform by enough in any given year, that can actually kind of buoy multiple years of underperformance. And so one, it just in terms of the math, it would look like, yes, this individual has outperformed the market over any given time frame, but two, this kind of happens quite a bit in any active strategy that starts to emerge. Is someone has a good year and that makes the returns look good on a kind of average basis over starting to get to a long enough time frame, where if you outperform the market by 10% and then you spend the next 8 years underperforming by 1%, you actually probably did outperform pretty close, depending on fund flows, etc. But there are people who kind of use that data both for like career purposes of like, yes, I've averaged outperform the market over these time frames. But then we kind of get back to, yes, but you're not outperforming the market by enough in any other year. Like you haven't been able to repeat that process. It's how much of that overperformance in that one year was just the result of luck or excess risk, something like that. Going back to our conversation about trying to compare equity returns to a bond index, sometimes it you might be taking on some kind of excess risk that happened to pay off. You could be leveraging, could be going kind of lower quality companies that are high risk, high reward. There's other ways you can do that by taking on excess risk. It just happens to outperform enough in that particular year, and then it's going to show that yes, you have averaged more than your benchmark over a long enough time frame, but we still don't know that's the case, kind of thing.
Yeah, you bring up another good gotcha in all of this. Frankly, one way that our 50 active managers could cheat the system is they could try to outperform in the first year, and then the 49% according to your number that outperform, then they could just invest in the S&P for the next 79 years.
Yeah. So and like we take 50 active managers, half of them outperformed in that first year, and so then they just match the benchmark for the rest of it, and it looks like, oh yeah, we have 25% of our 100 people sample outperform their benchmark.
Yeah, and the reason I kind of say this is a strategy that may be employed by actual mutual funds, meaning if a mutual fund does pretty good in 1 year, it's quite likely that they would be less incentivized to take drastic risks in the following subsequent years, because then their chances, as we might find out once we start looking at the data, of actually outperforming consistently is lower than 50%. Well, in that case, yeah, if you make a good bet and you want to hold on to it as long as possible, then you probably don't want to take risk after that.
It's just like, it's also like just one of those common sense things. It's like we tell clients all the time, for those other advisors I talk to who work with equity compensation, yes, it's holding on to the company stocks is a really high risk, high reward. But if you've already won, if you've already gotten the high reward, we don't need to keep taking on the risk. Let's move to that diversified portfolio. Let's start bringing in bonds. And it's kind of the same thing. It applies to just a normal career for a money manager. If you already took the big risk and it paid off, there's no incentive to continue taking the risk.
Right. Yeah.
It's actually like it's a career risk component to take on more investment risk.
Mm-hmm. Yeah. So in this example, what we're discovering is that if we really have somebody who's trying to beat the market, they set a benchmark like the S&P, and they said, okay, I'm going to pick the next best 10 stocks each year for the next 80 years. And if the following year the same 10 are the best, then that's fine. If one or two drop on, then I'll find another two. A well-defined strategy like that, and run it for 80 years, something like that. Seems like that would be a strategy we're talking about, a notion that is realistic, and it's possible that this is what people are doing in real life. Well, yeah, the numbers say for something like that, the chances of being a winner year after year are quite low. But, frankly, what we're really concerned here, as you mentioned, is how did you do on average as well, with the understanding that hopefully you did follow this type of methodology for the entire period.
Yeah.
So this kind of begs the question then, where do we go from here with the actual data that's available?
So I am curious, given kind of get to the benchmark, concerns about time frame and years, and even what we're seeing, like the outperformance 1 year. But okay, so I am curious, when you try to answer the question for yourself, how many people actually perform the bench out? How many people actually beat the market? What was your kind of conclusion for your own answer or for your own question?
Well, I think it's not something I've asked myself at one discrete time, but I think I've kind of accumulated this breadth and depth of knowledge on little bits of evidence along the way, over the past 10, 20 years. And they all kind of added to the larger picture, which provides me with the understanding that I think that number is very, very, very small. I feel like that number is well below 50%. And if I had to guess, it's probably well below 1%, like we said, over a 10-year, but we're talking about an 80-year. So I think it's even well below that, if I had to guess. And the reason is just, again, because of all these little bits of evidence that I've kind of seen along the way. But then, at the same time, I kind of asked the question because I get the feeling that individuals who aren't necessarily knee deep in the data and what's going on in the financial space, or maybe they follow stocks anecdotally and whatnot. But I get the feeling there is a large demographic of individuals who feel that the chances of individuals beating the market, or the percentage of people beating the market, is far higher than this less than 1% number.
Okay, so I guess, do you think there are some people that do beat the market?
Yes. Over an 80-year time frame? Yeah.
Okay. Because one of the thoughts I had was, I know there are professional gamblers that exist, that especially when it comes to sports betting, and I don't know how to compare stock market to sports gambling, in terms of like expected value and comparing to a benchmark and availability of information and just randomness. And it's not the point of this question, but I know kind of, even after accounting for what's called the VIG, it's the amount you have to pay to the casino or the house to take the bet. The house is just trying to put a bet on one side, a bet on the other side. They try and come up with a line in the middle that gets half the bettors on each side, so that all the losers are paying the winners, and the house is just collecting the VIG in the middle. And it's usually on a scale of 10%. A minus 110 is a very common betting line for two numbers that are pretty close. So to kind of make money consistently and make up for that VIG, which implies there's a negative expected value, bettors roughly have to win 55% of the time. And I do know that there are people who are able to provide their living through professional gambling. I do know these people exist. But when you say it about kind of how many, I do start to think, okay, you know what? Maybe it is down around that 1% or less number. Maybe kind of the stories we hear are those few outliers. Because if I had to guess, yeah, it's definitely not 50%. But it's also like kind of, it goes back to like that sample size question of all sports gamblers, definitely not even close to 50 are making a living gambling. And it's probably not even close to, of all gamblers, 0.5%. But if we're trying to create a subset of those who are trying to make a living through sports gambling, or of those who are trying to make a living through active management, how many able to succeed in this regard, it still might be a pretty small number. I would guess like my initial guess now is on that scale of 1 to 5% of that subset. And those are the stories we kind of hear. And so that might imply it's definitely less than 1% of the overall population of either active stock picking individuals or active sports gamblers. So I think you're right that there's a difference between, do you think someone is beating the market consistently, which I think you and I probably agree, yes, but that's not the point of the question. It's how many people do it, because that's what actually makes a difference in people's lives.
Yeah. I think that's a very key point here. The notion is if only 1 in 100 people are able to do this, how much time and effort should we put into this particular goal? It's a notion that if you had a 99% chance of matching the market, or a 1% chance of beating it, but you might also do worse, then which would you go with?
Well, so that's not. I guess that's close enough, because I do kind of distinguish. There's a 90% chance you're going to trail the market by a basis point, or by whatever your basis point fee is. It's probably all in. It's going to be somewhere on the scale of 5 to 50 basis points, depending on your asset allocation, risk tolerance, etc. But very roughly, most good programs are probably doing this on the scale of 25 to 35 basis points, like that. Like when you into like a better mental wealth fund, robo advisor, direct indexing strategies, other ETF program, like to actually have an asset allocation. But kind of, yeah, you're going to trail your personal benchmark by 30 basis points ish. There's a 99% chance that you're going to do that. Now, realistically, for vast majority of people, that still is the best scenario for them. But I think it's, when we talk about this kind of conversation, it's not 90% chance of matching the market. It's acknowledging that there still has to be some costs, and we're going to incur those costs.
Yeah, that's fair. In terms of what those costs are, that's probably, in the hypothetical scenario where we had the 50 people could invest passively, we're hoping that they were able to do that quite cheaply, hoping that they chose indices that are readily available and don't require significant amounts of magic.
Yeah, but these are ETFs that didn't exist 50 years ago. Maybe existed 50, but definitely not 60 years ago.
Yeah, which is why we're running this forward for the next 80 years. We'll meet up in 2100 to see the results.
So,
but yeah, I like what you said in terms of comparing to the poker players, because there is a demographic of individuals where that type of performance is tracked. These are professional money managers, and there is a scorecard out there that we can use to leverage. And hopefully that can provide us with insight on, okay, how do people who devote their lives to this task end up doing? We don't have their entire life recorded in a history, but we do have subsets which may be insightful.
yeah, it's also, I think there's I think there's a size distinction that's really important, and it's almost played out a lot. Where I have an example of poker players as well. It's a good example of, there's definitely skill there, people who make a living, and they can probably make a good living for themselves. But you can't have thousands of people investing in that poker player's winnings. Kind of, you could have small pools, and they have done this. There's actually a really good book, the Banker something and the Suicide King. I forget the name of it, but it's about a Texas banking billionaire. He wanted to know if he could make betting limits kind of so high to make professional gamblers nervous and professional poker players nervous. And it's just so it's like no single professional poker player could afford to play against him, so they would have to actually pool their money to be able to play against him. So I do know these pools exist, but you can't. So kind of there's just you can't invest thousands of people putting money in this poker player, because if they could play with $10 billion to manage, there's no other side of that game. There's no one to play against, and that single player can't play at a dozen tables at once. And so the poker player can make a living for themselves. They can't outperform the kind of the randomness or the odds of gambling for others. Maybe if, like, again, that small handful, but like not at any kind of scale. I think we actually do see that in active management, where smaller strategies start off and they're doing well. And if they were kind of content to try to just invest their own money, they probably could keep doing well. But again, that's kind of part of the conversation. Maybe they can't. They're just in that lucky time frame. But as they start to raise money and bring more money in, they can't replicate the early success. That they can't do it for all the other people.
Yeah, that's a very good point. So there are certain concerns when you try to scale money management, because the notion is the more money you apply to a strategy, well, then you're just watering down the potential opportunity. And there
Yeah.
isn't an infinite supply of opportunity.
Yeah, if you actually are able to identify a strategy, and it's like, okay, I can do this. Here are the kind of 5% extremes, one side or the other, that have played out, and like there's a really strong reversion to the mean aspect in investing and in markets. And so if you kind of can play that reversion to the mean of, if we get to an extreme, now's my chance to kind of take advantage, and I'll benefit from that version of the mean. But if you're trying to play it out 6 to 10 to 15% on those extremes, then it starts to not work. You only have that small amount, and sometimes it's only like 1 or 2% at an extreme. But like you said, as soon as you try doing more, it starts to water down. You're taking those kind of those. Okay, I have found something that's a 90% chance of working based on the extreme, but there's a list of 100 securities. Like, you get this probability. It'll work 90% of this time, work 85% this time for this stock, it works 80% for this stock. And you start to kind of, with other people's money that have been pooled together, you have to go farther down that list, and it looks less and less attractive. And like you said, it does kind of water down those opportunities that you may have found.
Yeah, I think that's a good point. There's other reasons, like you said, that why the smaller vehicles may look good. It could just be this notion of, some smaller vehicles have to look good, but once they scale, even if they didn't scale in size, they just might start doing worse, just because, time, they got lucky initially and then time caught up with them.
Yeah.
So what we see in some of these sets of data is, for example, we have data that looked at a large set of managers. In this case, this was data from Morningstar, where they looked at pretty much a big universe of actively managed portfolios, and they asked a question. What percentage of these actively managed portfolios underperform their style benchmark? So again, these are professionals. They had to say, here's my benchmark. My benchmark is small cap value stocks. And I'm going to stick to that. And over time, you're going to see, what percent of the time I do better. And, they ran this set of analysis on the data. And that what they noticed, for example, with, let's look at the large cap blend. When we talk about blend, these are growth and value stocks. So pretty much that's all the stocks in the S&P 500. And the notion is these active managers were trying to beat that benchmark. And what the data says is, if you open up a paper and you look at 100 different actively managed portfolios or funds that are trying to beat the S&P 500, 79% will have done worse over this time period. This is 15 years, over a 15-year period. And it's interesting because, that's not a high number at all. That's less than a coin flip. And it kind of gets even worse because the 100 that you see in the paper, it doesn't include the dozen or so that died over the last 15 years. The ones that did so bad, they didn't make it to that paper, on the 15th year. If you include those dead ones, you account for this notion of survivorship bias, well, that 79% jumps up to 94%.
It's, and that you said that was the large cap blend over last 15 years.
Yeah.
I assume this is after fees.
Yeah, this is their excess return after fees.
Okay. Do you have anything on other asset classes or diversified strategies, like how many people can beat a 60-40 if that's their benchmark?
I have a few other things. So, for example, small caps did a little bit better. The notion is those markets are more inefficient. There may be some more opportunity there. So, for example, there, instead of 94% of managers underperforming, it's 78%. So, of the styles that I'm looking between small and large and value, blend, and growth, these 9 different styles, that was the best.
Anything on fixed income or international or emerging markets? I don't know if they have the data on that.
So there's a few things with that particular set of data. It's a different set of analysis, but here we're looking at this notion of what percent of what number of managers in terms of like a regression. You kind of plot this on a chart, and the x-axis is your over/under performance.
Okay.
Right, where the 0 line is you did the same as the benchmark.
Yep.
And on the y-axis, what they actually did is they plotted the fees, meaning the more you charge, the higher your fees. And they looked for this notion of, okay, is there a pattern here?
Yeah.
And then they also colored the dots between actively managed portfolios and passively managed indices. And what they noticed in all of these cases is this regression line had a negative slope.
I was like, how close is the negative correlation to 1?
Well, it depends on your axis and how you.
That's true. That's true. Yeah.
Label it, but,
yeah.
But the notion is the higher your fees, the less likely you are to overperform or outperform your target benchmark. And the rationale here is kind of interesting because you would think, wait, I'm paying more in fees and the performance is going down. How does that work? And why would anybody do that? Well, what's happening here is investors are chasing returns. They see an initial period of good performance that they're like, oh, wow, doesn't this look awesome? Maybe I'll jump ship and sell what I have and jump to this new hot thing.
Yeah.
And, and if you look forward, instead of backwards, you look at forward from that point, well, then their returns are likely lower than what you got in at. So it's this notion that, yes, past performance certainly does not predict future returns. There's a reason why. That's one of the few statements that the SEC requires fund managers to say over and over again. But there's also this notion that chasing performance leads to this level of underperformance on the act of the actual investors who are doing the investing. So for example, there's this completely other set of data look from Morningstar that looked at how investors end up chasing performance. For example, in theory, an investor that invests in municipal bonds should get the municipal bond return. You would think, why not? But it turns out the average municipal bond investor gets the municipal bond return minus 1.4% a year.
Is that from? It feels too high to just be fees.
It's not fees. What's happening is they're chasing returns. They're trying to figure out which one bucket is the best to jump into, and they're picking wrong. So, this is true across all the various dimensions, including balanced international equity, diversified emerging markets, commodities, alternatives, municipal bonds, high yield bonds, and so on. In all of these categories, the actual investors who put their money to work in these categories end up doing worse than that category return by a good amount. And the more exotic that bucket is, the more underperformance they're likely to see. So, for the S&P 500, the blend, they probably underperform according to this data by 1/3% a year. However, for emerging market bonds, they underperform by about 3% a year.
So I think it might be too long to have a discussion today because I know Dalbar has done a study trying to kind of quantify the value of advisors in terms of basis points percentage, and they looked at fund flows, things like that, and it originally kind of really overstated the numbers, kind of what you're talking about, what investors got based on kind of those who were working with advisor, those who weren't, and selling out of stocks when we're down because they're scared, and buying when they're up because that's when they felt confident or greedy. And it overstated because it didn't quite take into effect just systematic contributions into investments. So people who are working, saving money into their 401k, saving money into their IRA or Roth IRA, or just into a taxable investment account. Once you accounted for the idea that people are systematically buying in based on their income and savings and investing, then still, say, a vast majority of investors were following some kind of systematic investment strategy, but it was that money going in, because kind of if the market's down, then you're seeing again the same level of dollars going in, and I forget exactly how to interpret it, but it's they're still putting money into bonds as well. So that did affect fund flows, and it's still kind of, most people aren't chasing those returns. It's still only a smaller percentage, something like 10 to 20%. Most people are picking that strategy and then saving into it consistently. But of those who were trying to chase returns, it did line up with kind of close to what you're talking about.
Yeah, like I think the effect that you're mentioning would likely be uniform across all these different buckets. If people were, averaging into high yield and averaging into equity and averaging into balance and so on. But the fact that we see a large amount of underperformance in the more exotic categories kind of implies that beyond just averaging into those exotic categories, people are likely doing, trying to be a little too fancy about things.
Yeah. Okay, so I think it's taken maybe a year and a half, but I think you have convinced me enough that acknowledging that there are some people who outperform a benchmark, but one, the number of people or percentage who can do it consistently is probably lower than even I had thought, because I hadn't kind of gone down that path. Two, identifying the people who can consistently outperform benchmark, or finding that 1% might be impractical, because you're more likely to find someone who had good past success than either they are not going to replicate it because they can't, they got lucky, or they're either consciously or subconsciously making intentions not to take on the risks that they took in the past, because their career incentive is to just stay with the benchmark and kind of ride that overperformance that they already had. So percentage of people who outperform the benchmark probably lower. The ability to identify those and actually benefit from any kind of potential overperformance moving forward is also really low, and pretty strong negative correlation between kind of fees and overperformance. So a negative correlation between fees and overperformance, positive correlation between fees and underperformance. Most likely higher fees equals underperformance. And just making changes along the way. That was never an issue for me. Kind of like I do a pretty good job of, okay, here's our strategy, and just leaving it alone. But I think you have kind of convinced me to look to lower fees more than I was. I was always kind of aware of it, but it was just one of the things instead of the first thing, if that makes sense.
Yeah, it does make sense. And I think also what I'm trying to say is, again, I mentioned this earlier in this conversation, the notion that I feel like there's some sort of conception out there that's kind of lingering under the surface that there is a demographic of individuals who play the markets that end up beating it consistently. And I feel like that exists for a variety of reasons. One, because you would think, these are professional managers, and there's still a good amount of money invested in actively managed mutual funds. I think that amount is still hovering around 50%, if I'm not mistaken. It's been going down year by year, but that's still a good amount of money. And then at the same time, people think, well, okay, that the mutual funds are targeted towards retail investors. What about institutions? Maybe they've got the inside scoop. These are endowments and foundations and pensions, these with billions and trillions of dollars. Maybe they figured all this out. Well, there's data even saying that institutions over this, this is another set of data, over this 10-year period, 86% of them underperformed their benchmark.
Okay, I think you've convinced me. I think we might have to talk about taxes and kind of where I still do see opportunity when it comes to tax management. I think that there's one last thing, but I think that's another conversation for another day.
Sounds good. I think we touched upon the institutions and the professionals in this conversation, but there's plenty of other insights to draw upon on just how individuals do when they try to manage their own money. So that I think there's a good amount here that we might pick up at some point as well.
Okay. This is a fun conversation today, Trishul. Thank you very much.
Well, thanks, Aaron. I enjoyed it as well. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.